Welcome to the Deep Dive. Today we're going to cut through the noise of, well, a really monumental corporate announcement. I mean, this one didn't just move a stock, it basically re-anchored an entire investment thesis. We're diving into the Q4 fiscal year 2025 earnings call for Photronics Inc., which, trades under the ticker PLA. This call was on December 10th.
Right. And our mission here is to really figure out the management's core strategy, to understand the super aggressive guidance, and get to the bottom of why this call triggered such an explosive reaction from the market. For you, the listener, we're basically giving you the shortcut to understanding the big operational shifts behind all this volatility.
Okay, let's just unpack this immediately, because you simply cannot discuss this call without starting with the aftermath. I mean, the financial beat was huge, but the market's reaction was almost irrational.
It was a true conviction event. It really was. The headline was the earnings per share, non-GAAP EPS came in at 60 cents per share. Now, you have to remember, analysts were only expecting 47 cents.
So that's a 28% positive surprise. In this sector, that's enormous.
It is. And the revenue was also incredibly strong, around $215.8 million, easily clearing what the street was looking for, which was closer to $204, $205 million.
And what's fascinating to me is what the margins tell us. Gross margin up to 35%, operating margin hitting 24.1%. That immediately suggests this wasn't just about selling more stuff, right? It was about selling a much, much richer product mix.
Precisely. That mix shift, that is the entire thesis here. And the market's verdict was just immediate and aggressive. The stock, it had closed the day before in the mid-20s, 25.69 to be exact.
And it just rocketed.
It absolutely rocketed. It closed the session at $37.35.
A single day gain of 45.4%. That's not a quarterly bump, that is an earthquake.
It is. And the trading data backs it up. This was high conviction money moving in. We saw about 15.5 million shares traded that day. That's a staggering 8 to 10 times the normal daily average. But here's where it gets really interesting.
The options market.
The options market frenzy. The capital rushing in was just, you could feel it. Traders bought 14,832 call options. That is a 1,329% spike above the average daily volume.
Wow.
And it was all concentrated in those near-dated upside contracts. This tells you that big money suddenly sees PL Lab as a structural growth story, tied directly to these huge secular trends, not just some cyclical semiconductor play.
So to ground that euphoria in a bit of reality, let's look at the actual numbers.
Yeah.
Management reported a GAAP EPS of $7, which is way higher than that 60-cent non-GAAP number you mentioned. Walk us through why that 60-cent figure is the one we should really be focused on.
Yeah, that's a great point. The 60-cent number is critical because it strips out the one-time accounting noise. Management was clear that the 107 figure was boosted by a non-recurring, non-cash, $16.8 million deferred tax valuation allowance reversal.
Which is a fancy way of saying they had a good accounting tailwind because of a better U.S. outlook.
Exactly. It's great to have, but the 60 cents non-GAAP, that's the core operational number. That shows you the real recurring profitability of the business itself.
And the single biggest reason for that 60-cent beat has to be that high-end pivot you talked about earlier.
Absolutely. The strategic shift is paying off in a huge way. They achieved record high-end integrated circuit, or IC, revenue. This high-end part of the business now makes up 42% of their total IC revenue. And it grew sequentially, even while other parts of the market were facing some serious headwinds.
And that tells you they're making the masks for the most sophisticated high-value chips out there.
That's it.
So why now? Why is this high-end mask demand hitting records at this exact moment?
Well, it connects directly to the biggest macro trend happening in the world right now, AI and data centers. Management was very explicit. This demand is broad-based, coming from their foundry and memory customers, and it's fueled almost entirely by that massive global investment in hyperscale data centers for AI.
So we're talking about the complex masks needed for the most advanced chips, the ones that train large language models.
Exactly. They saw strong accelerating order patterns in both the US and Asia for these advanced products.
It's really crucial to remember, though, that the overall picture isn't perfect. The call made it very clear that while the high end is flying, the mainstream is really struggling.
And that contrast is the critical dynamic here. You have to understand both sides. Management called out continued softness, pricing pressure, geopolitical impacts, all hitting the mainstream IC market, especially in China.
So they're making a strategic choice.
They are. Their strong high-end performance is offsetting this general market weakness. They're focusing their capital. I mean, even retiring older tools and reallocating capacity, all towards these high-value, high-margin opportunities. They're optimizing for quality, not just for quantity.
And that difference between a high-end mask and a mainstream mask, that's key to the whole margin story. Could you just quickly explain why the high-end ones are so much more profitable?
Sure. It really all comes down to complexity and defect sensitivity. Photomasks are basically the stencils used to print circuits onto silicon wafers. As those circuits get smaller and smaller, as we move towards 8 nanometer or even EUV class layers, the masks become incredibly precise. They're just far harder to make. Defects are catastrophic. And so the average selling prices, the ASPs and the margins, are dramatically higher than for your standard older node masks. They're selling premium shovels for the AI gold rush.
Okay, let's shift to their other major segment, the flat panel display, or FPD business. That came in at $58.3 million, down sequentially. What's the story there?
Right. So the FPD business was a bit softer in Q4, mostly due to timing, but it's still a long-term strategic asset for them. Management expects a solid rebound pretty soon, especially driven by the ramp of what they call G8.6 AMOLED projects.
And what are those exactly? G8.6 AMOLED.
So FPD is just flat panel display. G8.6 refers to a very large generation size of the glass substrate. And AMOLED is active matrix organic light emitting diode. Basically, you should think of these as large high-performance displays. They're crucial for premium IT monitors, advanced car dashboards, high-res medical screens, not your average TV.
Got it. So another long-term growth story.
A very long-term story. The ramp for these new applications is still in its early stages.
So before we look ahead, this huge bet they're making on high-end capacity,
Yeah.
it's only possible because their finances are in order. How did the balance sheet look at year-end?
The balance sheet is a fortress, and you need that context for their next move. They have $588 million in cash and short-term investments, and crucially, they are nearly debt-free. Yeah, and their fiscal 25 generated almost $250 million in operating cash flow. So they have this massive cash stack that lets them make these huge structural long-term bets without having to go ask for money.
And that leads us right into the Q1 guidance and, maybe more importantly, the capital expenditure plan. This is the part of the call that really sent a shockwave through the market.
It was a shockwave because it just completely redefines their scale. Q1 guidance itself was solid, revenue guided a bit higher between $217 and $225 million, EPS between 51 and 59 cents, solid, but, expected. The surprise was the monumental plan for FY26 capital expenditure, approximately $330 million.
Wait, $330 million? That is a massive spike from the $188 million they spent in FY25. Where is all this money going? Why spend so aggressively right now?
They're funding their future. They're aligning all this new capacity with two huge trends, advanced chips and reshoring. A massive chunk is going to the build-out of their high-end IC facility in Allen, Texas. Tool installation is starting soon. Customer qualifications are slated for 2026, and they expect initial revenue late that year, ramping hard into 2027.
That U.S. reshoring play seems incredibly important, both politically and economically.
It's their unique selling proposition. Management really stressed that they are the only U.S. headquartered company that can produce these trusted masks. The Allen facility just reinforces that position, capturing all that demand that's looking for a domestic, secure supply chain. It's a huge geopolitical tailwind they're riding.
And the second big investment is in Asia, for diversification and technology.
Exactly. They're also funding a cleanroom extension in Korea to capture that leading-edge outsourced work. They're talking about qualifications for 8 nanometer nodes through fiscal 27, with revenue starting in 2028, so they're thinking 5 years out.
This is a long game.
It is. They also confirmed their new advanced multi-beam mask writer in Boise is in full production now, which deepens their tech edge even further.
So we have to connect this massive capital spending back to that trend you mentioned earlier, captive outsourcing. Explain that connection for everyone listening.
Right. This is the core revenue capture mechanism. So many of the big chip makers, the foundries or memory companies, they have their own captive mask-making facilities. But those in-house facilities struggle to keep up with the insane technology curve for AI chips. So these new capacity additions from PLAB are explicitly designed to capture those higher margin outsource layers from those captive mask makers.
Because it's just too hard or too expensive for the chip makers to do the most complex stuff themselves.
Exactly. PLAB is placing a massive bet bet that this trend of outsourcing the hardest, most complex mask layers is going to continue and even accelerate.
Let's put this into the broader context then. PLab seems perfectly positioned in this global AI-driven semiconductor upcycle. Industry revenues are projected to hit $1 trillion by 2026.
It's a huge wave to ride, for sure. The photomask market itself is forecast to grow from $6 billion today to over $7.6 billion by 2030. And management even kind of downplayed competitive concerns from their new rival Texan, noting that PLab's stronger FPD business and their growing U.S. high-end share from the Allen facility gives them a real competitive edge.
Okay, so here's where we get to the core risk, the thing you really need to be aware of. The market has re-rated this stock based on fantastic long-term potential, but that potential came at a huge cost to near-term cash flow.
That trade-off is absolutely crucial. The company explicitly chose strategic investment, that massive $330 million capex over maximizing free cash flow today.
They're prioritizing future market share over cash in the pocket right now.
They are, and the market rewarded them for it, re-rating them as a structural AI infrastructure supplier. But the risk is all in the execution. If there's sustained underutilization of all this new expensive capacity, if the AI cycle slows, or if that outsourcing trend doesn't happen fast enough, it could really pressure their returns.
So basically, institutional investors are going to be watching the utilization rates at Allen and Korea like hawks for the next 2 years.
Precisely. And it's vital to remember the stock has already priced in a lot of success. I mean, a 66% return over the last month far outpaces the semiconductor benchmarks like the SOXX ETF, which was up maybe 11% in the same period. The market has already validated this story.
All right, now we shift gears for our final segment. And we have to say, this is not financial advice. We're not endorsing any trade. But given the extreme volatility, the strong underlying thesis, and this immediate euphoria, we always look for an outrageous but plausible trade idea.
Okay, so given that 45% pop and the 1,300% surge in call buying, we are clearly in a period of high implied volatility. That makes near-dated call options really expensive. But the fundamental story, the successful ramp of that 2027 high-end capacity, is incredibly compelling.
So how do you use that overheated short-term pricing to fund the long-term bet?
Well, you implement a strategy to sell the immediate excitement to buy the long-term fundamentals. The goal is to harvest that high volatility premium that exists right now. Specifically, you could sell a high premium, short-dated, out-of-the-money call spread. For example, selling a January 2026 $45 call and buying a $50 call to collect that premium before it decays.
And what do you do with the credit you get from selling that short-term volatility?
You use that credit to fund the purchase of a deep-in-the-money call option, or even better, a LEAPS, a long-term equity anticipation security. A LEAP is just a very long-dated call option, maybe one that doesn't expire until late 2026 or 2027.
So it ties your entry price directly to the successful ramp of that Allen, Texas facility.
Exactly. The strategy effectively hedges against an immediate overheated correction while keeping you exposed to that robust 2027 high-end IC thesis. You're using the froth to buy the fundamental story.
That is a sharp way to play the tension between momentum and long-term execution. So to recap our deep dive, the Q4 call for Photronics successfully re-anchored the entire narrative around AI-driven demand and a massive strategic capacity expansion. This clearly justified that aggressive 45% market re-rating.
And as always, please remember that all investing carries risk. You must conduct your own due diligence before considering any investment or trade. We're just reporting on the information in the earnings call.
But here's one final provocative thought for you to mull over. Management forecast $330 million in FY26 capex, a monumental investment. But what if the AI gigacycle accelerates even faster than the most bullish models anticipate, pushing demand and utilization way above expectations and earlier than 2027? Could this aggressive capital plan actually be viewed, in hindsight, as too conservative to capture peak market demand? And what would that mean for their competition? Something to consider as you watch that Allen facility come online over the next 2 years.